Hey Jones, fancy seeing you here at this meeting. Long time no see. Last I heard you were at over at Lehman Brothers. How have you been?
Hey Smith, I know I've been busy issuing low quality subprime mortgages, speculating on the stock market, and just generally destabilizing the economy, same old, same old. Still working at Goldman Sachs?
Indeed. Did you know that after signing our contract, they actually gave us a pair of Goldman Sachs?
Whoa, the name suddenly makes sense now.
Oh, I love them. I put them right on my desk. They're the focal point of the entire office. I tell my secretary, Tina, I want you to shine those up so I can see my face in those Goldman Sachs. Boy, do I love them.
Wow, sounds quite nice.
Anyway, Jones, you seem a bit troubled.
Oh, I'm just confused. I was reading something in the paper about how the Fed policy is thrusting their large sums of money in and out and in and out and in and out of the economy. To affect mortgage rates, but I don't understand it.
But I thought you were experienced in raw, elbow-deep, hard macroeconomics.
I see your point. I should be able to orally give you every detail on how the macro systems work. However, I specialize in short-term financial decisions designed to bring millions of dollars from profit without care or thought to how large your economy is affected. Honestly, I know nothing about macroeconomics.
Here, let me explain it to you. The Federal Reserve is the central banking system in the United States. It's run by small to average group of unelected individuals who seem to have magnum-sized power over the national economy and are not subject to congressional oversight or any kind of accountability.
Just like us.
Exactly. The main difference is that they actually care about the well-being of the economy as opposed to just bountiful quarter.
I do like me some bountiful quarters.
Aw, yeah. Now, the Fed is some sort of dual mandate. Its goal is both to provide the maximum possible employment for the country and simultaneously make sure prices are relatively stable. No crazy inflation. This may seem simple, but it's actually not that easy. Employment and inflation go hand in hand. While there is high employment and low inflation, it's difficult to go both ways.
Oh, I've been going both ways since college.
Still, there's a few ways to try. The Fed tries to influence the federal funds rate the rate to which banks lend to each other, because this in turn influences customer interest rates. The easiest way to go about this is through open market operations. Here, the Fed buys or sells treasury securities in an attempt to manipulate the short-term interest rate and determine the overall amount circulating through the economy.
Treasury securities?
Yeah, like bonds.
Oh, I know all about bondage. But what I was reading in the newspaper, though, they'd never mentioned that.
You're probably reading about quantitative easing.
Oh, I think you're right. I remember now. That paper was bursting with concepts of easing, but I couldn't quite get it up enough to finish it.
It's a rather uncommon thing. The central bank buys private equities from commercial banks instead of government bonds.
Oh, you can buy private equities?
Equities. They do this when short-term normal interest rates fall close to zero, since normal monetary policy would do little at this point. Quantitative easing will help the longer-term interest rates fall, and certain rates such as mortgage rates will also fall. This in turn will speed up the economy.
Ah, I see. Everything makes a lot more sense now. I should call you whenever something hard is on my mind.